Yo, what's up, folks? It is Thursday, April 20th. Another down day. Another tax drain yesterday of $16 billion so far since the beginning of the month. $255 billion drained. I told you this was coming. These are, seasonal happenings. You just got to know they're coming, and you could prepare for them defensively, or you can just let them happen and use them as buying opportunities. But the only thing about this one in particular that bothers me again is the debt ceiling situation and how that will end up hopefully to be resolved. Because if it's not resolved, if it goes into like a default, it's basically like an austerity situation, and that's just like a spiral to the bottom, and that's just going to be really bad. But hopefully it won't. So I gotta tell you, I gotta be honest, that I'm kind of impressed by the market's resilience, even though it's been down 3 days, and I've been telling my subscribers to take a defensive position with being short the market or puts or in cash or something like that, just waiting on the sidelines. But this is not a collapse. This is a very orderly reaction to a drain in financial balances. It's not something that should be too difficult to understand. When you're writing checks to the government to pay taxes, you have less there to play with. And that's really what it amounts to. Now, yesterday's drain of $16 billion, as small compared to the previous day, was something like $180 billion or something. But yesterday also included a $25 billion Social Security payment. So even with that Social Security payment, it wasn't enough to offset the tax drain. Next week, on the 26th, what day is that? That is Wednesday. There'll be another Social Security payment. And don't forget, the month of May, we have the quarterly interest payment. So that's going to replenish a decent chunk, not all of it. Those Social Security, those quarterly Treasury interest payments, they've been around 47 billion. So that's going to help. So we should stabilize. I'd say, maybe next week, maybe, very early May, start to stabilize, and then we get that quarterly interest payment, and it's not going to, we still have a lot to recover. And I don't think the complete tax drain is over. But compare it to last year when the market was crashing. By the way, we also have the Fed meeting in May. I forgot what date that's on. But if we get some positive news from the Fed, like they're saying 25 basis points, and then maybe give some indication that they're going to pause, we will get some help from the monetarist zombies. They'll be on our side for a change. Remember, last year they were freaking out because we were just getting started with the Fed rate increases, and they were going gangbusters at 75 basis points a clip, or 50. I think the first one was 50, the second one was 50. Anyway, like I've explained in the past, those initial rate increases, percentage-wise, were much bigger than the ones that came later. Like right now, at 5%, and they're going to go up another 0.25%. That's a very small percentage increase. So the impact is going to be a lot less than kind of like when we went from 0 to 1%. So maybe we'll get some help from the monetarists after the Fed meeting, and then we just got to get through the debt ceiling situation. I think once we get through the debt ceiling situation, then hopefully we start to see these leading spending flows, because I got to tell you that these leading spending flows have slowed down quite a bit. I don't know, I didn't have time to do a video yesterday, but they slowed down to the lowest pace since December 12th. That's not good. I mean, in December 12th, we were coming off the lows of spending in October. October was the low in the market. It was the low in the fiscal flow, and we were coming up. So we dropped back down again to that level, and I'm not quite sure why. Maybe that has something to do, the Treasury's balance at the Fed. I mean, that was under 100 billion. It's up to like 265 billion as of yesterday, so they got some money in there. But maybe that slowdown in the fiscal flows had something to do with the balance, the TGA balance coming way down, and maybe Treasury slowing up payments. I don't know. But that was not good because it was reinforcing or reassuring to see that leading spending flows, I kept talking about this, they were on a very, very discernible uptrend. And as long as, when I look at that and I see leading spending flows on an uptrend, I'm not worried. I mean, you just buy every dip. But when I start to see that break down, that's a problem. And it has broken down. So I would still stay cautious at this point. I think we got to get through, obviously, what remains of this fiscal drain. May looks a lot better with, your normal sort of Social Security payments and of course the quarterly interest payment. And then hopefully they get their act together on this debt ceiling, and we start to see things go back more or less to a normal spending flow, and I think that's going to be positive. So, wish I had better news to tell you. I still say on the bearish side, like I told you this was going to happen in April with the drains. As a matter of fact, you could go back and listen to my video or watch my videos like in early February, even before that. I mean, you could watch my videos in December, and I said that February 15th was going to be the peak in the fiscal flows. And that's exactly, I mean, if you had sold the market up there at February 15th, you'd be feeling pretty good right now. So, I mean, it's not about these rate adjustments, folks. I mean, the rate adjustments are just income redistribution. It's about these flows. I give you these almost with like absolute pinpoint accuracy of when these things are going to go up and when they're going to go down. And again, I say as long as the government is running a deficit, that means it's a continuous net addition to the financial balances of the economy, right? It's filling up the swimming pool. Sometimes the swimming pool gets filled up a little faster than other times. Sometimes the swimming pool gets drained for a period of time, like what's happening right now. If you understand that, I mean, it's like understanding that the tides coming in and going out. I mean, you don't freak out. You just know that, certain times of the day, the tide's coming in. Certain times of the day, the tide's going out. Happens 4 times a day. And we've got the same kind of pattern when it comes to these fiscal flows as we do with the tides. And just, I think the point is to understand. To understand, then you could be non-emotional about it. And better yet, you can take advantage of it. And that's what I'm here for, to educate. So that's it for today. Hope everybody had a great day, and see you tomorrow. Bye.